This is both good and bad because it emphasizes scale over quality. And as you know, anytime that the industry has a chance to skimp on quality, they will, of course, do it. This has really revolutionized fundraising for the sub-billion market cap space in the United States and to a lesser degree in Canada. What I'm seeing is, not surprisingly, that the future of natural resource investing is moving to younger people. It's moving to non-Caucasian people, and it's moving increasingly to female people. I would suspect that mining company managers who don't take note of the changing demographic will experience a higher cost of capital in the future.
Is the uranium bull market over? What's the most hated commodity right now? And is that a signal for investors? What happened to the long-term buy and hold strategy? Has the investor demographic changed? And what metals should you be putting on your radar? These are just some of the topics I cover in my two-part conversation with today's guest, with a man who needs little introduction in the resource space. I'm Shae Russell, and welcome back to Cocktails and Commodities, the resource podcast where macro analysis meets mining insight. While you're here, give us a like, but please remember, all information is general in nature and not financial advice. Joining me in the Cocktails and Commodities studio today is Rick Rule, President and CEO of Rule Investment Media. Though Rick's been around for a considerable period of time, as he's been investing in the resource space for more than 45 years, and he's participated in a number of private equity transactions when it comes to junior exploration stocks. Let's get on with it. Rick, how are you today?
Shae, I'm doing well. The better to be on with you. Thank you.
Now, Rick, I'm going to try and not take up too much of your time today because I was forewarned at the start of this conversation that it's me between you and a whiskey right now. But it's 9 o'clock in the morning here in Australia, and we can't really drink at this hour without alarming our guests. So let's kick off today's conversation because I have a lot of questions I want to cover in a very short period of time. First and foremost, I want to talk to you about the changing investor profile. Now, for anybody listening this week and who might see me next week, you might wonder if I'm getting Rick to do my homework, but I'm hoping Rick's going to give me a different answer to what I'm going to hear next week. Now, Rick, first and foremost, when we think of the investor, we think of a grey-haired man who wears a tie and that likes to research stocks and invest their retirement savings in there. But I have a theory that that's not who tomorrow's investor is going to be. Now, you reach a wide audience. Can you tell me, has the investor profile changed from what it used to be to what it is now?
Well, thank you, first of all, for calling me a gray-haired man as opposed to a no-haired man, but I understood the reference. And certainly in resources, the demographic that I represent is literally dying. So by definition, they can't be the investor of the future. What has amused me really in the last 4 years, but it's picking up speed, is the demographic change that you refer to, the different composition among both active and passive investors in natural resources and precious metals. We've learned by doing data analytics at Rule Investment Media, both in terms of the composition of our paid audience, which is to say our boot camp and our conference audience, but more rapidly, the composition of the Rule Classroom and Rule Investment Media audience is that they are in fact changing. If you would have looked at our data 35 years ago, you would have seen exactly what you alluded to, grumpy old men, dominantly Caucasian in the United States and Canada, with the odd Aussie and the odd Brit. The Aussie's odder than the rest, of course. And what you're seeing today is very different. First of all, in terms of the new respondees, well over 30% is female. Women years ago, depending on their taste in men, would have regarded an investment conference as a target-rich environment, meaning that there weren't very many women there, as you could attest. That's changing. And the audience is increasingly non-North American. Yes, a larger Australian contingent, but really a contingent around the world. I would say that, interestingly, in the gold trade, the fastest growing contingent in the world is South Asian, which is to say Indian, Pakistani, Bengali, and Sri Lankan women, admittedly from a small start. Uh, uh, the demographic trend has been interesting enough in my own database that I several years ago interviewed a group of these women in Sunnyvale, California, downtown Silicon Valley, and found a few things that probably wouldn't have surprised me if I knew more about this cohort, but surprised me nonetheless. First of all, uh, the Indian women told me that this shouldn't be a surprise because they have 1,000 years of familiarity with precious metals and 2,000 years of experience with government, which made them as non-trusting as I, but based on more experience and less narrative. A response which I found very funny. Two, at least among the Indian diaspora, uh, this is a high earnings cohort. This group of young women were all engineers in Silicon Valley. Had any of them got lost on their way to work and pulled in front of another building, they would have been hired immediately with a pay raise. Uh, Despite the fact that none of them were 30, they were all high earners, and despite their high earnings, they couldn't afford to buy a place in Silicon Valley. So they were all living substantially below their means, generating really, really, really strong surpluses, investable surpluses. What I'm seeing is, not surprisingly, that the future of natural resource investing is moving to younger people. It's moving to non-Caucasian people, and it's moving increasingly to female people. I would suspect that mining company managers who don't take note of the changing demographic will experience a higher cost of capital in the future. We're seeing capital formation in the junior resource industry change very rapidly, too. The constraints around capital raising imposed by the investment banks are breaking down. Uh, Earlier stage investing, which is to say private placement investing, is taking place among substantially fewer people with a bigger representative around family offices. The bottleneck, if you will, that was represented by the investment banks, the toll gate, is increasingly broken down. The family office investors, in particular, don't need, and I'm being charitable, the intercession of the investment banks between them and the investment targets. But the next thing that happens, at least in North American markets, is the advances in at the market financings. These are evergreen prospectuses where the issuers can monetize the aftermarket volume in a stock to raise capital on a day-to-day basis, monetizing some of the volume that comes in. This has really revolutionized fundraising for the sub-billion market cap space in the United States and to a lesser degree in Canada. The third thing that I think everybody has to recognize is the increasing numbers of passive investors and the increasing influence of the ETFs. What this means is that the successful issuers have to get larger faster. And we're seeing more market success accrue to the amalgamators than to the discoverers. Simply put, 1 + 1 + 1 is beginning to equal 4 as opposed to 3. As the companies become bigger and their trading liquidity increases, they become added to the equities indexes, which means that they experience a lot of free buying, if you will, from the ETFs outside of normal channels. This is both good and bad because it emphasizes scale over quality. And as you know, anytime that the industry has a chance to skimp on quality, they will, of course, do it. But I think what investors in the junior space need to understand are these new flows of money and how they work. The early stage investment in private placements is becoming an increasingly constrained club, which I suspect will lead to an increase in deal terms for these same investors. The second thing to understand is access to a really highly liquid market. Self-serving for me to say, but in particular the US market. and the ability to participate through the market makers in at the market financings will be a critical way to build a company in the next 5 or 10 years. Well, it'll be a critical way to build a company next year, if it isn't this year. And the third thing to understand is that we are in the era of growth for growth's sake. This isn't necessarily the right way to invest, but it's certainly the right way to understand capital formation in the industry. I believe, but I've seen no statistical evidence yet, that the industry continues to be radically short of good discoveries. And I continue to believe that the fourth theme that we're going to see will be the takeover of successful efforts in exploration at fairly eye-popping multiples. Now, we haven't had a chance to test that because we're still in the very, very, very front end of the exploration cycle. The exploration expenditures that we saw 2006 through 2011 are just beginning to be felt now. And that's typical. My experience has been it takes at least a decade for new exploration ideas or new exploration efforts to bear fruit. So we're starting to be on the front end of the discovery cycle, really as a consequence of the exploration boomlet that took place in the second part of the first decade of this millennium.
Uh, Rick, as usual, I start today's interview with a blueprint of where I want to go, and then you give me an answer, and I throw the blueprint out the window, and now we're winging it. That is a really insightful answer, and I love what you talked about there with the increasing number of South Asian women participating in the gold sector and obviously financial markets and the living below their means. That's a great story alone. But I want to just backtrack a step to what you said about passive investing and the rise of ETFs. Now, my theory, I don't have any data, it's all anecdotal, is that the moment that young people, and I'm going to say that, the 20s bracket, they're starting to dabble in the markets and they're using ETFs. Now, yes, this is a resource podcast, but we will get back to that in a second. Tell me, can we consider passive investing as a sort of a lack of a way better putting it, a gateway drug to the rest of the market? Or does it risk investors becoming lazy and entrapping themselves in these, as you put it, scale over quality products?
I think the answer to that is yes and yes. I think that you will have some investors who begin as passive investors and as a consequence develop knowledge about a sector and invest deeply. There was a point in time in my life when I felt for various reasons that passive investing was not a good thing. I always believed that the best manager for one's own money was oneself. The market pushed back at that and said, I want to stick to my knitting. I want to do my job. I want to look after my kids. I want to read my books. And in the absence of the investor taking control of his or her own finances, it probably does make sense. The second thing with regards to passive investing is there's a lot to be said for beta. The nature of a resource bull market is that the market itself, during those periods when it comes into favor, generates so much return that you don't necessarily have to outpace the market. You merely have to be in it. Yes, of course. If you hit the right small stock at the right time, you get a 10 bagger or a 15 bagger. That requires a lot of work, a lot of luck, and a lot of patience. And many people don't have any of the three. Buying an ETF in the sector, as an example, had you bought a uranium ETF at the time that we did the uranium boot camp 18 months ago, you'd be up 150% without having to do any work. And the ETFs are highly, highly, highly liquid. It is lovely to be in a product where maybe your readers don't know what an owl stock is, but an owl stock is one where you call your broker and say, I want to sell, and he or she says, to who? To who? These ETFs are highly liquid, and if you want to get on, you can get on. If you want to get off, you can get off. Whether we like them or not, they're with us. And we have to take the reality, the hand that we're dealt, when we are charting out paths for our future. And so the ETFs are with us. Whether or not they're an efficacious instrument for all of your listeners is a different question. But when you are considering corporate finance in the natural resource based businesses, you need to understand that the ETFs are and will continue to be with us and important.
Now, let's get into the actual resource part of cocktails and commodities. And first of all, I want to talk about the what I'm starting to see, and I think we actually have touched on this conversation before. Um, I want to talk about the increasing, not threat of nationalization, but the fact that nationalization of certain mining assets is going to happen over the next decade. We see it with the Chilean government moving into acquiring more lithium assets that were once privately held. Now they're being sought into public ownership. But what is this about the United States taking an interest in Australian resources? Now I'm hearing whispers that, oh, and there's been deals where the Department of Defence has done a deal. A company comes There was a company recently where the US Department of Defense funded basically a cobalt project to get it up and running. Now, the US is resource rich, Canada's resource rich. It makes sense to acquire deals in that part of the world. But why would the United States government even consider getting in bed with the Australians?
Well, the United States government has a wonderful track record of wasting money. Uh, the Inflation Reduction Act gave Congress well over $1 trillion of conjured up money to play with. And I guess there weren't enough opportunities to waste money in the United States. And so they needed to export this profligate spending. And the closest place, a place where basically we speak the same language, was an opportunity. In all seriousness, the U.S. Department of Defense and the U.S. Congress has come to the understanding that they don't live in a unipolar world anymore. There are countries that object to the extraterritorial imposition of U.S. power, and there are ascendant cultures that don't have access to resources the way that the U.S. established access in the 1950s, 60s, and 70s. And those countries, particularly China, are beginning to search for their own sources of supply where their access to those supplies aren't controlled by somebody whose interests they consider to be different than their own. And there are certain commodity groups where, in fact, the Chinese are believed to be in control. Cobalt being one. Yes, cobalt mining takes place mostly in the Democratic Republic of the Congo, but the Chinese control at least 60% of the formal and informal production in the Congo. And the refining of cobalt into cobalt chemicals takes place mostly in China. As we have seen recently with regards to graphite, graphene, gallium, and germanium, the Chinese are beginning to respond to American pressure by putting some pressure on of their own. And the United States is waking up to the fact that it is no longer a hegemon and must continue to secure their own access to their own supply chain in a variety of materials. Dealing with resource nationalism and confiscation of assets, I think you need to draw two distinctions. One is the overt and honest nationalization, what the Chileans did. The sense that, yes, the foreigners have made us a lot of money in the lithium business, but lithium is too good a business to leave either to private interests or the foreigners. We're going to steal more. The other is theft or nationalization on the installment plan, simply with higher taxation and more regulation. The type of economic nationalism that might be practiced in the real basket cases like the United States, Western Australia, or Queensland. I think it's very important that we, to quote Pogo, have met the enemy and he is us with regards to nationalization. It either happens in an overt, honest fashion in places like Congo, Peru, or Chile, or it happens through subterfuge like in the United States or Australia.
Oh, that's a good answer. Now, again, jumping back and forth between some of the great things you've said today is you mentioned earlier that we're at the front end of the commodity cycle. Now, or sorry, the front end of the exploration cycle. I can't get back to the page where I wrote that down. But the reason why I bring this up is when I was at your conference back in July, I was at Boca Raton, and I was fortunate enough to host several workshops. Um, every breakout session that I hosted, there was at least one investor there that stood up and said to these companies, but what is the likelihood you are going to be a takeover target, or who's going to take you out? Who's your nearby neighbor? Now, the reason why I put this in front of you is you've seen a few commodity cycles in your time, and you've seen investor psyche change over that time. Tell me why, when people were at a resource conference, why was there this fixation, consistent fixation on a company being a takeover target?
Three reasons that I can think of, Shae. The first is that through my career, I've been very fortunate to be involved with a lot of company builders, the Lundins, Ross Beatty, the earlier Robert Friedland, where the realizations were all takeovers. These guys took the front end risk that the major mining companies couldn't or wouldn't take. They were successful in building investor franchises that gave them the intermediate stage funding that many of their competitors couldn't arrange. And the consequence of that is that they were able to offer up compelling bargains, and exits happened. So people that hung around me as investors for 35 years were unusually lucky with regards to takeovers. It became the expected exit. Not that it was something that I set out to have to occur, but the guys that I hung out with managed to affect that. I believe that the second reason is that people have begun to be bored with the underperformance in the junior sector and resources in 2021, 22, 23, and they're looking for the prospect of relief wherever they might come from. The third is that I think there's a realization that by historical metrics, at least, the better smaller companies are cheap. And the probability of takeover going into 2024 is high. My suspicion is that with some of the issuers, as they continue to add value, either the share price goes up or they become taken over by companies with lower costs of capital. So I think perhaps the last reason is rational, which is to say, if you ask me, of course, we had a highly curated group of companies at that conference. They were much higher quality and hence had a higher probability of being taken over than the market as a whole. Also, there's investor fatigue. People have come to regard even good natural resource companies as value traps, always a wonderful sign of the bottom. And the third is that they've become, at least those who have been with me, like many of them had for 3 decades, accustomed to that being the exit.
All right, time to talk about minerals and metals, or two in particular, and that is uranium and silver. Now, you know what? I always thought silver investors were a passionate bunch, but I've recently discovered that uranium investors were probably a more passionate bunch. We're going to start talking about uranium right now. Now, first of all, you very casually mentioned earlier on that if investors bought into your uranium ETF 18 months ago, they would have enjoyed a lovely ride higher. Now, tell me, there's been a lot of false starts in the uranium market. Is this bull market going to stick around, or is this just another false start and investors were jumping at shadow as the uranium price rose?
I think I'd be tempted to answer that question by saying the easy money has been made. The easy money is always to buy when there is at least boredom or preferably hate in the market. And saying nice things about the uranium business in an interview like this a year ago would have resulted in scathing comments in the question and answer, which I always like. There's nothing that lets me know that I'm right about an investment thesis as good as hatred. And uranium had that hatred. It's gone from hatred to love, which tells me that the easy money has been made. I suspect that there are at least 2 good years left. For the same reasons, Shae, that you and I talked about a year ago, a year and a half ago, or 2 years ago. You'll recall, or maybe you won't recall, you've had a lot of interviews since, that I said that the uranium bull market would get underway in earnest when the pace of Japanese restarts happened. Well, that happened in 2023. And that used up the available above ground inventory. The uranium price rose, and the consequence of that is that the price of uranium stocks rose. I believe that the incentive price to bring new production on scale is a minimum of $75 US, which is within striking distance. My own suspicion is that this uranium bull market has at least 2 years to run. But I wouldn't discourage people who own baskets of uranium juniors from selling enough now to get their bait back. What's wrong with uranium is it's no longer hated. And so you don't get that first double for free anymore. You've already enjoyed it. Often people are well advised to take the easy money off the table and let the big money rise, which is precisely where we are with the uranium business. It's important to know that this bull market isn't over. You're seeing the volumes traded in the commodity itself move from the spot market to the term market. That's very important because these are negotiated contracts that take place over 5 years or 10 years or 15 years. What that does for the producer is if they lock in a contract price that's rich enough, it ensures them sufficient return on capital employed that they can finance new projects. It isn't something that they enjoy today and is gone tomorrow. It is estimated now that as much as 80% of the market that's taking place, the volumes that are taking place in the market are taking place in the term market, which means that you'll see, as an example, Kazatomprom and Cameco able to return production to market, having found a home for it, not waiting down the spot market, at the same time that they ensure reasonable returns on capital employed for their vendors. This is a wonderful set of circumstances. It also causes companies like the Australian company Boss, but also Paladin, NextGen, Fission, to obtain permanent financing for their projects because offtake is insured for long enough to amortize the construction loan. And I suspect that this generates a re-rating in the developers over the next 2 years, which will extend down, pardon me, to the explorers. But make no mistake, the easy money has been made. The easy money is made when a sector is hated. Which brings me to your second commodity. People.
Well, people.
Go ahead. Go ahead.
No. We'll get to silver in just a second because once again, you said something clever. What's the most hated commodity right now?
I would suspect among speculators it's silver. I would suspect overall the most hated commodity is probably coal, followed by oil and gas, both of which I love.
Let's go into that because coal's controversial, but you can't have windmills without your met coal.
Yeah, I'm not going to get into that whole debate. I'm one of those who believes that we shouldn't pump more crap into the atmosphere and more crap into the ocean. I'm one of those. I'd love to leave the world a better place than I found it. But when you look at carbon in the very near term, the trade-off is carbon or poverty. There are 1 billion people on Earth, Shae, with no access to primary electricity. These people would like to live like you and I and like your listeners do. And to do that requires more energy of all kinds. Added to that billion person number, let's do maybe a little more arithmetic around carbon. In the last 40 years, we've now invested $5 trillion US in alternative energy. And we've taken the market share of carbon-based fuels, fossil fuels, down from a high of 82% all the way down to 81% with a $5 billion investment. The largest year on record for coal demand was 2022. That demand was eclipsed in September of 2023, which means despite the pronouncements of the big thinkers, coal demand around the world is increasing, not decreasing. And when you get to carbon, you can see the reason why. The big thinkers in the world, and you'll notice I use that term advisedly, your prime minister, my president, Angela Merkel, that noted energy physicist, Greta Thunberg, the big thinkers of the world would have you believe that the right way to measure carbon is by national quota. People in frontier and emerging markets think that carbon utilization should be measured per capita. In other words, they don't think that 1.3 billion Chinese should have the same national quota as 330,000 Americans or however many Australians there are. And I think they have a point. Secondly, those people point out that the carbon loadings that the big thinkers find so destructive, and probably are, were mostly contributed by Western nations. And they think that the citizens of Western nations should pay a penalty for past sins rather than getting a pass on the past sins and being held to account in the future. So I think in the West we have two choices. We can either, pay $10, $12 a liter for gasoline, and 70 or 80 Australian cents per kilowatt hour for electricity, or we can understand a different output in the near term for carbon fuels. The idea that India and Indonesia and Malawi and Myanmar and Bolivia are going to subsidize the United States and Australia in terms of energy consumption in the future will not sit well with Australian and American voters. And as a consequence, it won't happen. The protestations of the big thinkers notwithstanding. How does that get back to coal? Well, the narrative has driven coal equity prices. The cash flow that coal producers have enjoyed has been off the charts, even as the equity prices have fallen. And the demand outlook for coal, at least for the next 10 years, the only time that cash flows matter from a net present value viewpoint, will stay very, very, very strong. The press makes a lot of mention of coal plant closures in the United States, conveniently ignoring that a new coal-fired plant opens every day in frontier markets. If you want some amusing narrative, it's interesting to note that the West Germans recently had to knock down a wind farm to expand the cutback from an open cut coal mine.
Oh.
The visual image, I mean, I realize that statistically that's not important, but the visual image of that was amusing to me. Not too long ago, Glencore, a major coal producer, which has the courage to double down on their coal production, bought the 40% of a Colombian coal mine that they didn't own from a partner. Mind you, this mine has 3 decades of reserves left. They bought it for 1.5 times free cash flow. In other words, this investment has an 18-month payout with a 30-year life. It's very difficult to imagine a commodity that has better prospects, that is more hated than coal. Now, are there problems? Of course. The big thinkers of the world are trying to constrain access to financing for the coal industry. What the Chinese are saying is if JP Morgan Chase can't help you, Industrial Commercial Bank of China can. So what happens is that the sources of capital change as the opportunity continues to mature. So I would suggest for investors, the hated commodities, which is the place that you want to be, are oil and gas and coal. For speculators, the hated commodity is easily silver.
And that's where we're going to next. Let's talk about silver. Now, look, silver has basically done this incredible V shape, is the best way of describing it. It went
Yep.
down at 100 miles an hour and it's come back up pretty
Yep.
quickly as well. Um, look, there is a pocket of the internet that is passionate about silver, perhaps beyond reason. However, there is an incredible base case for silver as an industrial use. But what I don't understand is why people would hate silver, because as far as I can tell, my analysis tells me that the future for silver as an industrial metal is incredibly bright. What's your view on this? And
I
why is
think
it
people
hated?
hate silver because they had stupidly high expectations in 2019, 2020. You'll recall the Reddit silver crowd who believed that there was a broad-based Wall Street conspiracy to depress the price of silver, and they decided to stick it to the man and profit at the expense of J.P. Morgan Chase. Now, frankly, an IQ contest between Reddit and J.P. Morgan Chase, let's just say that the heavy end of the scale wouldn't be Reddit, okay? Um, but I also think that the time expectations exhibited by the silver bugs were wrong. I can't tell you enough about silver to tell you really the dynamics of a bull market in silver. What I can tell you is this: I've been through one real one and two little ones, and even the two little ones were stupidly advantageous. It would appear to me that in a precious metals bull market, gold leads it. The fear buyer is first. And when gold establishes the precious metals narrative as credible, silver, perhaps because of its lower unit cost, in the latter half of a bull market, greatly outpaces gold. It moves further and it moves faster. But in my experience, gold has to establish the pattern. The most scarce of all natural resource investment assets are reasonable quality silver stocks. As my friend Doug Casey has pointed out, the combined market caps of the real silver stocks is so small that when the generalist investor is introduced to the narrative, there simply isn't enough market cap to control the money. As Doug famously says, it's like trying to siphon Hoover Dam through a garden hose. And that very upside volatility is, of course, what attracts the speculators. Speculators always are manic depressives, from my point of view, or at least manic speculators, which means when the bull market is underway, they're willing to take a third mortgage on their house to participate. And when the bear market is underway, they believe that some fundamental law of nature has been violated. And certainly the expectation that existed for silver in 2019, in an example, hasn't come true in the period 2019 to 2023. What that means is that based on their experience in the immediate past, they expect no change in the future. It is precisely that hate that causes bull markets. It is precisely that hate that causes bull markets. So I can't tell you when you are going to see an uptick in silver. Just as 2 years ago, had you asked me when the uptick in uranium was going to happen, I would have had to say, Shae, I don't know. But based on my experience in past markets, while this may not be imminent, it is in fact inevitable. And from a speculator's point of view, it's very difficult to overstate what happens in a silver bull market. My first silver bull market, now admittedly from a gold price controlled base, silver ran from $1.50 US an ounce to 50. My second bull market in the early part of the decade of the 90s, the silver price went from about $5 US, if my memory serves me well, to 50. Not as dramatic a bull market, but a 10-bagger is still pretty good. The third bull market, it seemed to go from 15 to 50. I'm not hanging out in the silver market to see it go from $23 to $26 or whatever US. I don't care about that. I have a fairly small bit of money invested in silver and a larger amount of money invested in the silver stocks because I think that there's a chance, a probability rather than a possibility, that you see a much more dramatic move in silver and a stupid move in the silver stocks. Am I sure it's going to happen? No. Am I delighted to see the malaise in the silver market? Am I delighted to see the vitriol and hate that silver enjoys in the comment section of popular media? I'm overjoyed to see that, just as I was overjoyed to be called a moron because of the uranium trade 18 months ago. Remember, I had been in uranium for 35 years, and the people who were rounding on uranium couldn't spell it. Uh, I suspect you're seeing that in the silver trade now. You're seeing 27-year-olds who say the silver hasn't gone up in 4 years, as though that has some relevance.
I really like that you made the distinction there for everybody listening between the precious metal silver market and silver stocks, because there's a divergence here between the two that a lot of investors don't understand. Now, when you ran your silver boot camp
Yes.
earlier in the year, tell me, did your attendees come with a fixed viewpoint, and were you able to change that viewpoint by the end of that boot camp?
We had a lot of attendees. First of all, I think that boot camp was attended by 2,500 people.
Oh, wow.
So you had a real cross section of people. You had some people who were dyed in the wool silver bugs. and who said to us that we missed the fact that silver was absolutely positively over the long weekend going to go to $200 an ounce. Now, I don't know that we succeeded in convincing them of very much. There were another group of conspiratorialists there, and our leadoff speaker, Jeffrey Christian, said that all the conspiracy theories were, to coin a popular American financial phrase, bullshit. And that didn't sit well with those people. We had a group of people there who just are sort of rural investment media junkies and want to attend all of our talks. And what we said to there was that we believed that over time, a bull market in silver itself was inevitable. And as a consequence of that, couldn't tell you when it was going to happen, that there was going to be probably a pretty stupid increase in the silver price. And I think we got a reasonable audience for that. The audience wasn't as excited or excitable as the audience who thought that they could stick it to the man and see the silver price go from $25, pardon me, to $250 on some monumental short squeeze. That wasn't on offer, frankly. I think we had a very sober product. We talked about the increasing utility of silver in solar panels and the much less understood increasing utility in silver as a germicide, its application in water treatment, chemical treatment, and waste treatment, which is the fastest growing use of silver that there is in the world. We talked a lot about the fact that very little silver, or a small proportion of the world's silver, pardon me, comes from silver mines. Most silver comes from recycling or comes as a byproduct from gold mines, lead mines, zinc mines, or copper mines. And the consequence of that is that understanding silver supply is devilishly difficult because you need to make forecasts about recycling technologies and about copper production, gold production, lead production, and zinc production. So it was an interesting circumstance. I can tell you this, Shae, anybody who went to the boot camp, almost anybody, came away knowing a lot more about silver than they went into it. And yes, I'm sure there were people who were disappointed by the sober nature of the boot camp. I think there were people who signed up expecting us to reinforce their own idiom, saying that silver is going to go to $25 to $200. But that's not what we do, as you know.
Certainly do. And tell me, is that boot camp available for replay anywhere? Because I am as I made before, very passionate about silver's long-term future and its industrial uses. I think it'd be great to have some
Absolutely.
clarity
If
out
you go
there.
to if you go to ruleclassroom.com, remember it's behind a paywall. It's not available for free, which most people would prefer. But the course material from all of our boot camps is available at ruleclassroom.com.
I will provide a link to that. And for anybody interested in paying, I do highly recommend it. I am quite passionate about base metal projects because you'll often pull out a lot of silver from them. So I do recommend anybody goes there. But before this interview must draw to a close, I have another question about one of your boot camps. And again, this is sort of leaning on a conversation you and I have had in the past. Out of this battery metal boot camp that you recently ran, what was the conclusion that you put in front of the audience? Because I'm convinced that what we're using today will not be the mass-produced product 15 years from now.
I think that's very clear. And I don't think there will be an emergent technology. I think that technologies will develop for specialties. I'm excited, as an example, about the utility grade prospect for the vanadium redox battery. But I don't think that has any application at all for a cell phone. I think the technology that evolves will be a range of technologies, and I think these technologies will advance. I also think that electric vehicles will emerge as one of, but not the, driving force behind electrification and energy transition. I think that 1 billion people on Earth with no access to electricity and 2 billion people on Earth without access to affordable or reliable electricity will be the driving force. the idea that you need to develop enough copper to get electricity to 250 million unserved homes, the idea that then you have to provide the ability for the home to utilize that electricity, the idea then that there are a whole variety of gadgets in the house which improve the living standards of those people that they haven't bought and haven't been built yet. And then the whole idea of distributed power, which is a fancy way of saying batteries. The idea that we need the ability to store primary energy, that we need the ability to store intermittent energy, the fact that we need access to power in all sets of circumstances is what we have to look at. Certainly, the demand for energy transition and battery metals will not be a one-way street. If we suffer a recession, a limited recession, or more troublingly, a global recession in the next 5 years, there will be a reduction, a near-term reduction in demand for a whole bunch of raw materials, including energy transmission materials. If, as some suspect, the centrally planned, perhaps over-indebted Chinese economy has hiccups for longer than people anticipate, then the impacts of urbanization and electrification are longer term rather than nearer term. But I don't think that anybody can doubt the increasing utility offered up by technology in the electrification of the world, and the fact that 3 billion people on Earth are going to be inexorably greater consumers of electricity and all things electrical. Whether or not the electric vehicle actually ends up making great big inroads against the much more efficient internal combustion engine is a very different question. Perhaps for political reasons it does, or perhaps the technology around energy generation, transmission, and utilization in vehicles means that electric vehicles become more rather than less efficient against internal combustion engines. But I don't think that conflating energy transition and electrification with the electric vehicle is the correct response. And I hope that that's the biggest point that we made at the Electric and Battery Metals Boot Camp. Don't conflate the two. The future is more bullish than you suspect, but there could be a hiatus as a consequence of a global recession.
That's a really good takeaway. Now, to draw today's interview to a close, I have two more questions for you. Simple ones, I promise. First and foremost, this is not really a question, but more of a statement. Generally, for people listening, especially for first time listeners or long time listeners, if you haven't taken Rick up on this offer, I highly suggest you do. Rick, tell me, what is something you like to offer for people who are listening to this podcast?
Yeah, I like to interact with your listeners, Shae, so I give them the opportunity. If you go to my website, ruleinvestmentmedia.com, and you list your natural resource stocks, please no tech stocks, please no pot stocks, please no crypto. I'll rank your natural resource stocks. No charge, no obligation, 1 through 10, 1 being best, 10 being worst. I'll comment on individual issues where I think my comments might have value. I've done this now for 80,000 people over the last 6.5 years. I've learned at least as much as I've taught, so I look forward to doing it in the future.
Again, a link to how to access Rick's ranking will be provided in the bio of today's podcast. Now, Rick, before you go, this podcast is called Cocktails and Commodities. Now, I recently enjoyed many a cocktail, maybe one too many on occasion, when I was in Boca Raton in July this year, and I look forward to doing it again next year. But tell me, while the sun sets tonight, will you be making yourself a cocktail? And if so, what will it be?
Actually, this evening, what I've decided is at home when we don't have any company, when it's just Bonnie and I've decided to give myself a holiday from cocktails, richly deserved, sadly. And so this very evening, I won't be enjoying spirituous beverage. As you know, I deserve some time off from spirituous beverage. But this very evening, in answer to your question, I'll be drinking. Well, I won't be consuming anything with alcohol.
Perfect. Well, then, in that case, I'll have to make sure I grab you for a cocktail next time I see you in person. Rick, it was an absolute pleasure to have you on. Thank you very much for your time today, and I look forward to speaking to you next time.
Always my pleasure, Shae. Thank you for having me back on, and thank you for the opportunity of addressing your audience.
After listening to Rick talk, would you consider looking at coal, oil, and gas stocks? Or perhaps are you now more interested in the long term role vanadium has in the energy transition? Or what might happen with silver as it becomes more commonly used as a germicide? Make sure you leave a comment in the box below because I definitely want to have this discussion with you. Of course, if you want your portfolio rated by Rick or to learn how you can access his recent silver book, of course, if you want your portfolio rated by Rick or you want to learn how to access his most recent silver boot camp, the links are in the description box below for you. That's all for today's episode of Cocktails and Commodities. Make sure you're following us so you always know what stocks are making news, which commodities are moving markets, and the companies trying to get it out of the ground.